Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Got an awesome show today. Today we're joined by Alex Morris, CEO, CIO of FM Investments, which is $19 billion, darn near $20 billion, darn near $50, $100 billion boutique investment firm. I don't know if you can call it boutique anymore when you're $20 billion. Alex and company entered the ETF Terror Dome just a few years ago and it's kind of burst on the scene, made a name for themselves. Alex is keyed into everything going on with bonds and fixed income. We'll talk about that a bit today. Alex, welcome to the show.
Meb, thanks for having me. After that intro, I'm worried it's all downhill from here now.
Could be. Last time we were going downhill on a bus in Utah, drinking some wine or whiskey together, which was a lot of fun.
We weren't driving for anyone listening, just so we're clear.
Good point. By the time this publishes, I will have seen you in person in Washington, D.C., which is where you're located, and then probably seen you in person again coming up. Listeners, come see us at Future Proof. As always, we will be hosting a free surf lesson Monday morning. You can email us for the form, the invite. We can commiserate over happy hour. I think this year it is the Bears-Vikings Monday Night Football at HQ Gastropub, also free. But again, you got to RSVP. So hit me up if you want to attend. Alex, you going to be there? You going to come surf with us?
I might have to just give it a shot. I mean, you have to promise not to laugh too much.
We're going to talk about a bunch of market stuff. This is your first time on the show. So let's give the listeners a quick background. You started out, like me, as an engineer. Give me your investment journey, because you've been all over the place.
Been all over the world doing stuff. My journey was supposed to actually take me to medicine and decided I didn't want to do that. I had a best friend who's an economics and econometrics major, and I was good at math, and he was good at the theory, so I learned a lot of the math of this stuff. Ended up at a hedge fund in London in 2005 and 6 when things were really rollicking and taking off. We built a great business with a group and ultimately did a couple of related ventures as the GFC hit, realized, wow, this isn't going away. Conventional wisdom was this will last 6 months as you watch folks with corrugated boxes coming out of Canary Wharf and Canada Water. And then I went to Santa Barbara, California, working at a private bank there and worked for a family office group they had, doing some other cool stuff. And over time, realized there was business to really be had in doing some advisor-facing work. Came to Washington, D.C. because I met a girl and fell in love and she told me how to move here. So I called her bluff. We now have 2 children and met up with a family office group where I really learned what was happening from the advisor side and investor side of the world. I'd been on the alpha generating side and everything's easy when you can close out your book by 5 p.m., right? Life is different when you have to actually go to the client and say you stuffed up. We sold that business called Fortigent to LPL and then learned that when you've met one family office, you've met one family office. But the advisory world is really diverse. And then saw this great opportunity to take some of that great alpha generation that we saw in the family office space and make it accessible to the LPLs of the world and to the mass consumer products. Because the way we would package those ideas up for a family office consumer, someone who's got $1 billion, is just different than how you'd put an ETF that we could talk about here. So you go through this sort of weird turn, add a little turn in investment banking in there, and it turns out I'm a terrible employee. I just am better at starting things and growing them than I am finding a job and sitting at a desk and doing what I was told to do on the checklist. Tried that once or twice, just never stuck. Turns out building stuff is a lot more fun. So we built FM to really help great alpha generators build this into a platform where they could find access to lots and lots of capital and do it in a way where that capital could trust that that alpha was going to be sustainable. Along the way, we found the ETF. We built TBIL. Funny story. I almost didn't call it TBIL. I wanted to call it
Great ticker.
Great ticker, right? And it's the ticker that almost never was. We also had RFR for risk-free rate. And I desperately wanted to call it RFR because it's
That's
the risk.
Not bad.
It's not
but
bad.
But the SEC is probably like you can't say that in the name. You can say T-bills, but you could.
Yeah, we didn't get that far. Marketing was like, how are we going to stop this lunatic from calling this thing RFR? And so I'll tell you what, let's call up a quant friend of mine from the hedge fund. And he was like, oh man, you got to call it RFR. That's the winner. Great. That's great. We hung up the phone and they're looking around the room like, uh-oh. Now he's definitely going to call this. Said, well, guys, you just got your way. We're going to call it T-bill. They're like, what? Like, he's a genius, but he's terrible at marketing. So the George Costanza rule applies here. So he built that, and now he found some really cool stuff like, ETFs. I think to traditional institutional advisor 10 years ago were like, those are for retail. They're not for us. Man, was I wrong. What a journey the last few years of building this and realizing all of the great things that are happening inside the ETF wrapper, the great ideas, and just how accessible we can now make really, really good investment ideas to so many people.
What was that decision? Because you guys are almost 20 funds later. What was the initial aha light bulb moment? Was there one? Or was it like, oh, we should just probably launch some ETFs?
It was probably opposite. It was frustration. We didn't want to do it. We kind of got dragged ourselves kicking and screaming into the marketplace. If you go back in our time machine to 21, which, wasn't that long ago, but feels like a few dog years ago, all of a sudden it's like we saw rates coming up. We wanted to put more treasuries into portfolios, and the FM business that time was very well diversified from super large institutional clients through, retail SMA and some folks who were just requisite fund buyers. And as we were doing trades of the cash bond, if we're going to roll the 2-year for you, so 12 times a year to stay on the run, and we wanted on-run securities for these folks because we love the liquidity that provides when, you don't think about liquidity in the treasury market until it's gone. So on the run, stayed liquid. We wanted to do this. We tried using other ETFs, some of the popular names everyone will well know, and we just couldn't get the precise action we wanted. We wanted to replicate buying the cash bond without the basis risk of buying the future. So how could we do that? And we tried really hard to not launch these things. And eventually it was just clear to get the exposure we wanted, we had to do them. So we came out with T-bill, U2 and U10, spread our bets across the yield curve in an effort to democratize, which is a word I think was pretty democratized anyway, but make it easy. And I bet if you asked all of us around here what would be the most successful, we all would have told you, and we all did. So there was no active market in the office here for it. It was U10. It's the 10-year. Everyone loves the 10-year. Well, it turns out everyone did love the 10-year. It was in a yield divot at the moment, but T-bills were through the roof, and the sort of simplicity of just buying the on-the-run 90-day and rolling it with high efficiency and passing through the SEC lending revenue just really resonated with folks. And $6 billion later in that fund, it's been an interesting ride.
It's fun to see you birth these ideas into the world, and often, as you mentioned, have a preconceived notion of what people want because it's often what you or I want or what we think is the need in the marketplace. And all of a sudden something totally different takes off. And that's the beauty of it, the agony and ecstasy of being an entrepreneur. But that's super cool. The weird thing is you scratch your head and be like, how did this not exist before? It seems like such a wonderfully obvious idea. not to.
No, you're absolutely right. I mean,
I'm saying that as a compliment.
Yeah, we take it always as such, even when it's not meant as it. So we're good at that now. But it's like any really obvious idea. It's met with ridicule, then scrutiny, then general acceptance as always being true. And we don't know why. I mean, if we kind of take our history lesson in ETFs, 30 some odd years ago, they burst onto the scene. Took a while to catch on. They're black magic in taxes, right? 15 years ago, you and I would be having the debate over VHS tape that ETFs and bonds don't work. So that all works. And I think the real genesis for all of us, for our products, I argue probably, a chunk of yours and some of the ideas you had, was the sort of 6C11 Cambrian, no pun intended here, explosion of ETF ideas where now it wasn't a 2 to 3 year journey that was super expensive and hard of specific relief. Really good and clever ideas could rapidly come to market. So most of the established players who were in the bond market were already in the bond market. That happens in 2017. You see a lot of equity ideas because equities were popular, things were going well. In 2017, 2019, it was choose your flavor of kind of zero. Rates weren't that interesting. Bonds weren't in vogue. You made a lot of money in the S&P 500 or adjacency to it. Why would you innovate in bonds and ETFs? It didn't seem to make any sense. It was a really small percentage of total take. Now rates are interesting. So all of a sudden more products come out. And certainly the hallmark names in fixed income ETF get a lot of action. To really be a bond shop, you generally have to be a bigger shop. Fees in general have been lower compared to equities. So there were just fewer players. And I think we were just at the right mix of brave enough to do it. And where I guess brave is equal parts, courage plus stupidity in that sense. And many of the bigger players who no doubt thought of an idea similar to this, right? Like if we go way back, we might remember the FITRs, FITRs, which are the fixed income treasury seats, like ADRs for individual treasuries to try to exchange trade them. There'd been tries at this. But the big guys, they already owned the space. You couldn't go and say, hey, I sold you this fund for the last decade. I now found a better way. For equal fee, move your funds over. I think that messaging was hard for many of those shops. They had other more lucrative, better ideas to go do. So it was open season for us and a handful of others who've come out and tried to innovate in the bond space, which just hasn't really much changed in the last 100, 200, 300 years, frankly.
Over a decade ago, so this is 12 years ago, I had fun where I was like, hey, let's do an ETF contest. Suggest an ETF that doesn't exist, that should exist. And it's a laundry list of ETFs, some of them like humorously bad, implausible, and others that you're like, oh, that doesn't sound, and then they're like $10 billion categories today. Almost all of them have been launched, by the way. So it's funny to look back at me at the time being like, oh, that's so stupid. And then it's like $20 billion. So who knows?
I find there's one good indicator. Like if you look at that list, that you could find the ones that aren't going to work, right? We find we do product development conversations. The first thing we want to do is ask people, would you buy this? Do you know where to put this in your portfolio? Where's there a good fit? Would you want to use this? The killer for any good idea around here like that, or any seemingly good idea is, oh, that's interesting. That's like the death knell. That's a hobby. That's something that's like, oh yeah, I could use it if, and the if just like never happens, right? If you want to be successful in this space, you got to find products that have immediate fit. It's the cool thing about ETFs. They're immediately available. Like remember when we were launching mutual funds, it takes like half a decade for them to get enough seasoning to be on a platform. But boom, ETFs come to life on a Tuesday, and there they are Tuesday afternoon. Like, it's pretty cool.
You guys are neck deep in fixed income. There's been a lot of excitement and interest around fixed income, Fed, markets, a lot of geopolitical news. Talk to us a little bit about just the fixed income landscape in general. Any thoughts? Could be on anything. Jackson Hole, firing people, yield curves, wherever you want to go with it.
Yeah, we're not officially talking about bonds till we talk about the yield curve. So I guess we should just tick that box and move on. Yield curve slightly more normal. Hooray. Don't know if that really helps. Certainly starting to signal to the market that maybe something might be wrong, right? It's not a break glass in case of emergency moment yet, but I feel like the market's got its hammer out. It's ready. Tariffs and whatnot have kind of toned down. Doesn't mean they're not going to be problematic, but the bond market flashed its warning signs in April. I felt like the first 2 weeks of April were a full dog year for those of us watching the market. So it's nice to not go through that again. But bond market otherwise has kind of settled in. We had a little bit, auctions are okay, a little weakish, but okay. Overall, there's sort of comfortable numbness, to borrow and mangle a Pink Floydism, that it's kind of okay for the time being. But there's like a rupture happening in the Fed. Talking about firing people, it's pretty rare to threaten to fire one Fed governor who's the chair, much less two, than to go ahead and try it, which, last time it happened, the guy died before they actually got around to settling the case. That's why we call it Humphrey's executor. And ironically, that Supreme Court case, for anyone who wants to go and read the annals of history, they weren't fighting over whether or not he could stay in his job. They were fighting over his salary, actually. Like, you have to pay me because you can't fire me sort of situation. So slightly different political event, but same theater. On the whole, look, it's kind of a wacky time to be watching the news because there's just some unprecedented, strange things happening. But for a bond person, I think we're often overly accused of being optimistic, and we're okay with that. Like, the market is a pretty efficient place and has a pretty good way of just kind of carrying on. We hit these kind of moments, bonds and currency. My wife was the social secretary for the EU embassy here in town for a long while, and I remember speaking to one of the ambassadors who gave me the best investment advice that I in the FX market that I ever got. This is during Grexit, so while you were taking bets on what ETFs would work, I was thinking about currency markets, and I asked him, how short the euro should I be? Like everything I own, or like everything I could mortgage? And wow, the ambassador looked at me and said, no, you should be long the euro. It's going to work. The Greeks aren't leaving. Everything's going to be fine. Okay, maybe he's got some inside info. This is his job, after all. And his response to me was, no, there's 600 million people who need this to work. It's going to work. And we kind of remind ourselves when there's all of this nonsense, political turmoil and doomsaying, and, look, as an industry, we kind of have this fetish for all of the things that could go wrong, from the, oh, that would be terrible, to like the fantastically silly wrong. But there's 300 million people here, plus the rest of the global economy, who kind of needs us to sort this out. We need this to work. And it turns out we're really, really good at making that happen. And there'll be some ups and downs, right? It feels like we're approaching the peak of a few things, but it's not like we're looking at Great Depression level things. There's just about anyone who wants a job can find a job. Inflation expectations are going back up. Real inflation is kind of tame, but probably going to tick back up, but not Argentina level. So we're kind of okay. And if you've been long the S&P 500 for the last few years, you're still a lot wealthier than you were when you started, and you feel pretty good about the whole thing.
Yeah, when we talk about stocks, particularly in the U.S., I say, look, I often tell people, I say, it's kind of almost as good as it's ever going to get. Do you feel fat and happy? You patting yourself on the back? It's been 15 years of 15% returns. That's pretty wonderful. No one ever is like, oh, this has been so good. Like, I don't know if I've ever talked to an investor. It's like, oh my God, this has just been the easy money. It's been chill. It's like always something to pull your hair out about. And that's true for all of history.
Yeah, it turns out the easy strategies, though, tend to work out pretty well because you can stick to them, right? We see a lot of harebrained schemes that come out, and they may work if you can follow this like really obscure recipe for a really long time, but it's really hard to do, even for us as professionals. Like, if you look at how we manage our own money, a lot of it's just doing really simple stuff, because just that done well over a long period of time really matters a lot more.
Talk to us a little bit about fixed income. Is this something do people behave any better in your funds? As you look at, like, Morningstar recently put out Mind the Gap, these type of situations, do they tend to be kind of more buy and hold with the traditional fixed income investments, or is it same story everywhere? How do you kind of see have you learned anything from investors in y'all's ETFs last few years?
Yeah, only that there's no one answer to that. We've got folks who are traffickers maybe multiple times a day in T-bill, high velocity, it's cash sitting there, and they change their mind, to some who they want to hold on to 10, 15% cash, and this is the way they're going to do it. Across the curve, we see lots of different behavior, from yield seeking to duration seeking, and there's no one investor archetype. You meet one investor in ETF, you've met one investor in ETF, sort of thing. And we do see some patterns and trends. It's hard with ETFs versus, say, mutual fund or SMA, where we kind of know what you're up to. Here, it's hard to track every investor, probably for the better in that sense, but a lot of different reasons to buy it. Our hope is, regardless of your reason, you have a good experience, and we deliver the experience you're expecting. And so far, touch wood, so good on that one. We're going to continue to do that. But I think the most surprising thing we learned was just how many ETF investors out there were. Some closeted who didn't want to admit it, big shops, and some who we didn't know we could now access. If you were to go on CNBC, Bloomberg TV, Fox Business News today, and you talk about your obscure SMA strategy, even if there's 5 million eyeballs watching you, maybe 15 people could buy that thing. Whereas in the ETF, almost all 5 million of those folks can go and type in 3 or 4 letters in a buy ticket and can do it on their phone. So just the broadness of appeal has been the most interesting for us. And we get a lot of questions, some that hit the switchboard that make our way to us, some through other channels. The retail investing population, so, sort of gen pop questions, never cease to amaze us with how good and detailed they are. You think it would be just the institutional buyers who come up the most cunning questions. And without exception, the top 10 questions on the list here, who were most interesting, thoughtful, all came from retail investors who might have been researching a decision for 100 shares or a million shares. We don't know, but just amazing to watch that, how engaged folks are. And I think it's a lot of the good work you and others are doing and pumping this content out that's meaningful and thoughtful, and folks who can rely on it. It's a lot harder to do that in a lot of other asset classes.
If people are worried in the fixed income space, what tends to be the concerns, or it could be something you're worried about? Are people feeling pretty chill about inflation? You see some of the corporates are trading at pretty slim margins relative to their benchmarks. Anything on either topic?
Corporates, high yield even, super, super thin, Spreads are about as tight as you may ever see them historically, which feels like that might be the beginning to the end of that for a while, but you're still making a decent rate. If you have a short-term memory of any measure, you'll remember 5 years ago when rates were effectively zero. We're talking about money market funds breaking the buck. So a number north of zero feels pretty good. A number north of 3 or 4 or 5 feels really good, particularly in that market. High yield is a little higher than that without a tremendous amount of volatility. So I think folks are feeling really good about that. Those who are worried, still are certainly trafficking the short end of the curve. And I think if there wasn't as much worry as there was, we'd see the short end spike a lot more than we have. So bits of that. We hear from folks, there's inflation worries. If you look at all of the stats from the University of Michigan, anyone else putting out stats, inflation worry is there. It's real. It's growing. We just haven't seen that turn up in the actual realized inflation numbers. And it's not unusual for those stats to diverge for a period of time. But I think eventually folks will start voting with their dollars there. We launched an ultra short, the first ultra short inflation product, RBIL, if you like TBIL.
I was about to ask about that because that's super cool. I think a lot of people got surprised about tips over the last few years because they said, well, I might have gotten the inflation part right, but I also didn't realize these are 10-year or whatever, longer, and I got pummeled on that part of the trade. Will you tell us a little bit about this product and idea?
Absolutely right. Folks if you were prescient in 21, you saw inflation coming January 1st, and you said, all right, I'm going to do the best thing I can do. I'm going to buy a low-cost tips tracker fund. Your choices were to go long, say 3 to 4 years duration or 7 to 10 years duration. And, let's say 3 didn't sound so bad, except 3 is actually a pretty big duration. 3 years duration is a pretty big number when you think about what the Fed's about to do. If you're afraid of inflation going up, and you're right, the Fed has to raise rates generally pretty fast and pretty high to fight that level of inflation. So you got the call right, which was buy tips because inflation's coming, but the duration cannibalized all of your inflation protection. And our bill, we built to do the exact opposite. How do we just get you the inflation protection with almost no duration? So it has about a 6-month duration on it. There is no such thing as a tips bill. So the Treasury only issues these things in 5, 10, and longer denominations. There's no 1-year version of it. So we go out and we just try to buy the ones that are within a year, manage our duration to about a 5 to 7 month bogey, usually at 6, and give you actual CPI participation. It's kind of annoying to hear fight inflation. You can't fight inflation as an investor. You can do that as a central banker, but not an investor. You can participate with inflation through something like our bill, or try to buy the things that are creating inflation and hope you get in front of them. And if you look at the inflation hedges in 22, gold collapsed on you. Equities were shaky. Real assets didn't hold up terribly well, and they're hard to buy and sell that corporate real estate practice that you wanted to buy. So this was the only game left in town, and we thought there needed to be a better answer. So first ultra short tips index out there, we had to have a new one built at Bloomberg. There was only one that was out there. And it turns out it was a year and in, which sounds great. The dirty secret in tips is you need it to be 13 months and in, because there's so many tips owners, large institutions, who just don't want to own tips within a year because it doesn't help their duration management program. So they dump these things coming into a year. So we built our bill to sort of absorb that structural cheapness there. And I wish I could tell you it was our idea alone. We teamed up with 2 really smart folks to do this. Mark Spindell, who works with us all the time now, wrote a book on the Fed's independence. He and his colleague Brian Sack have been working on this stuff forever. And, it took really, really super smart folks who've been doing this for decades to actually come out with our bill and something as simple as just buy the next 4 tips to expire. And like any really great idea that hadn't been done before, it's usually because really smart people want to make more complicated solutions. It takes, a little bit more bravery to try to do the simple one. Because when you fail doing something complicated, there's a lot of, you could say face a few ways. When you fail doing something really simple, just a bad idea then, it sounds like. Our bill is true to form and it's outperformed versus what expectations were for performance and inflation protection. And it's been a great product.
One of my favorite examples of market inefficiency is ticker confusion. When people think there's a ticker for a stock or an idea, but it ends up being the wrong company. It'll be like some tiny company, they'll be in the news, they'll type in the ticker and you'll see the volume explode. If you type in the TIPS ticker, and I know this because I unintentionally bought this years ago, the main sort of, I don't know if it's iShares or whatever, ETF, which is just TIP. TIPS, however, is the TN Wrong Internet Products and Services Inc. company, which is a pink sheets that has a 30 million market cap, but still trades 25,000 shares a day. 99% of that, I think, is probably people unintentionally buying this when they're trying to buy a TIPS ETF. That stock probably only exists to keep the market makers fat and happy. I don't know.
Well, if someone's making some money off that, I mean, that was the classic COVID one, right? Zoom versus, which is actually ZM versus Zoom, ZOOM. And everyone just bought the word. And this company that was just as surprised as everyone else to see their price go through the roof and their volume go up until folks realized, oops, wrong one.
That's so funny. You guys have been thinking about fixed income, been thinking about taxes, new products. I definitely was pretty excited to see your new Compoundr series. Walk us through the inspiration for this idea and tell us a little bit about it.
I'm here at the altar of the master of taxes and ETFs, so honored to be able to talk about it. Its roots really simple, right? There's two really inefficient things that happen with fixed income ETFs. One is we pay a periodic dividend, that the distribution that you either have to reinvest and we have to go out of our way to raise cash and pay you and you to pay it back to us. And it's messy. We do it generally when our competitors tend to do this. You can benchmark us, but it's not like any investor says, I really, really want my money on the 28th of the month versus the 27th. It's a thing all issuers have to do. And most investors reinvest the money, particularly folks we see the flows go out when we pay the distribution. We see the vast majority of it come right back in. Other funds see more leakage, but this is like inefficiency as we build cash to then hand back to you for you to buy the shares and hand back to us. So we wanted to find a way, particularly for institutional investors who would come to us and say, we like T-bill, we love XBill, love the yield, don't want your distribution. And that was when we at T-bill had gone to giving distributions out twice a month and we're moving to weekly. And folks said, look, if you give us any of our money back more frequently, we're going to take it away from you. Stop it. Just stop it with the distributions, please. And then we met up with some folks who started Claymore, the bullet shares, before it went to Guggenheim and Invesco. And they were like, hey, geniuses, same idea here, but people really don't like paying taxes, which is a consequence of getting that distribution. And why don't we do this on something that pays more than cash? I'm like, oh, if you're so smart, what in the bond market pays more than cash? Like, I don't know. How about high yield? You do manage high yield bonds. Like, oh, yeah, missed that one. Good idea. The idea is simple, though. That sort of desire for efficiency in the fund has this really cool tax consequence where you're not receiving a distribution, so you never get a taxable distribution. So if you buy a compounder, it will just compound price. It's total return. So what you see when you do a comp analysis of total return is what you actually get in price. You won't see the sawtooth pattern that bond funds have as they accrue all that income intra-month or intra-quarter and then pay it out at the end. It'll just keep rolling itself. We do that by buying other popular bond ETFs. And then before they make a distribution, we try to buy things that are similar. We can't always get things that are perfect. So we look to minimize tracking error and use modern portfolio theory to work out what's the best way to provide that exposure for the limited amount of time we may be out of that primary. So CPAG, for example, is the AG, CPHY is the high yield, and the AG will go buy AGG. And a few days of the month, we'll be out of AGG and buy something that's close enough, not perfect, but close enough. And then we'll buy back into AGG after that dividend period has passed. And it looks just like a tax harvest, just like folks in direct indexing are used to saying, just in the ETF, we can do it in kind and we can deliver price total return equal to price return.
When did these launch?
These launched 2 weeks ago now.
Congratulations. I'm preaching the choir, but we started thinking about this about a decade ago. And I was like, this is one of the strangest parts of all of investing to me, which is people that are in taxable accounts that are reinvesting A, their income and B, their dividends. The last thing on the planet you want are those distributions. And audience for that reception was always very small. And the reason being is that everyone loves this concept, this fantasy of passive income, right? It's just been kind of like drubbed into people's heads about, getting this. I don't know if it's like likening it to an allowance, a salary, another income stream, but people love this concept. But learning, and I've talked to many friends in our world who said the same thing as you do, who said, no, like we have funds that pay out these income and they reinvest it. And I said, why in God's name would they do that? I said, maybe if they're tax exempt, but the taxable ones, that's crazy. So I personally think you're going to see a revolution in tax location of products, tax focused. And you could make the argument, obviously we have a equity fund that likes to avoid or low to no dividend income. I don't understand why every robo-advisor or taxable investor on the planet wouldn't allocate to these style funds. Do you agree? Give me some devil's advocate. Why wouldn't they do this if they're in a particularly place like where I live, California? Tax rate's enormous.
We're hoping that you're right. That's the bet. And we think it's true. And we're selfishly the first buyers of the fund because we agree. I think there are some folks who said, well, I'll just go buy munis. And like we offer muni SMAs, great space to be, totally different asset class exposure, a lot of other things to consider, million plus QSIPs, lots of other opportunities out there. I think a lot of folks are going to, the main putback will be, why wasn't this done? Like clearly there's something wrong here. This took a long time to get here. And the same answer as earlier. It's just folks hadn't focused on this, right? The sort of ETF evolution wasn't mature enough. It is now, right? So that I would push back on anyone saying that. Some of the work you've done on 351, folks 2 to 5 years ago would have said was impossible. You've disproven that without any issue whatsoever. And I think folks were always looking at taxes as a problem that really only your accountant would solve for you with some interesting use of math on your 1040, which you shouldn't do, or expensive insurance products or other ways. And everyone looked at the ETF as its trick was tax efficiency of capital gains. End of story, done here, move on. And as we all start to explore new ways to do this, as folks have taxable wealth and non-taxable wealth, certainly if we kind of look at tax alpha generation, 15 years ago, beta replication from Parametric and Aperio and AIA, interesting that it's all kind of fresh tech money coming out of Seattle and San Francisco that was really into tax management, right? And those practices grew to multi-billion-dollar practices and were bought for massive multiples by BlackRock and Morgan Stanley and the like. And it was great. And then we heard a lot about direct indexing, the sort of like best idea that never really became much in that sense, but it was doing the same thing. I had an account that did that. It made a lot of sense. But there's just a certain simplicity in the ETF where now you can do this. And we kind of struggle to find reasons why you shouldn't. If you're a long-term investor, if you're a day trader, then this probably isn't the right vehicle for you. If your thought is you're not going to hold on to this, it's not part of an asset allocation, you don't want to be a long-term investor in the name, then the standard things are going to be just fine, right? There won't be the compounding layer on it. You'll know exactly what the market shows you. But for anyone who's doing this, to your point, as an allocation, as a robo-advisor, as an advisor to someone who has high income, particularly if they have high income and sort of as they're accumulating wealth or have a lot of wealth and a high income as a result of it, this is a great play in that sense. And we think it just gives folks what it does. And, part of the reason why we like it is simple. It just does a simple thing well over time. We're not trying to wow you with academic beauty of all this other stuff. Just do this simple thing, do it well, try to minimize the tracking error, and just deliver that result every day. And that was the message.
You very quickly mentioned earlier short lending. Is that something you guys do in your funds? And if so, can you explain what that means to listeners?
Sure. So most of our funds engage in securities lending. The funds sit in the account. There's a couple ways to do it. The way we do it is we use a third-party agent called ESEC Lending. They're pros. They do this all day in the repo market. They work with the likes of CalPERS and CalSTRS and big companies in that sense. And basically, we've got securities that others want to borrow for settlement or other purposes. So we go and we enter into an agreement with these counterparties. We demand that they give us more than 100% of what we're lending out to them, for which they give us basically a return. So think of it as interest paid to the fund for the use of these securities that we're not otherwise selling. They're just sitting in the account. And they say, we need to borrow this for whatever reason, for which if we're going to take out $1, we're going to give you $1.03 as collateral in similar securities that we're confident we can sell, for which we're going to give you some cash for the trouble. And we don't take a scrape from that. We just put all of it back into the fund. It's what we would all do if we all had $6 billion in our PAs. We would all do the repo trades just like this. So we manage that program. We give it all to investors, generates somewhere between 4 and 10 basis points, depending upon market conditions, of excess yield that we think investors should avail themselves of. T-bill is often the largest holder of the on-the-run 90-day note when it comes out. The second is usually the Federal Reserve Bank of New York, small institution that no one's ever heard of. And as a result, we recognized it was really important that we be plugged into all of these aspects of this sort of real bill economy, because someone else is going to try to set the rate on these things, and we don't want our investors to not participate. So we run that program. It's part of the reason why, and I forget the ticker, it's probably been lost to time, but remember about 12 years ago, there was an S&P 500 tracker fund that came out, and they offered this gimmick incentive that they would pay the first $50 million or $100 million of investors. They would pay you a fee. The fee would be negative to participate in the fund, because they were confident they could make so much money lending the securities out that it was worth it to just pay you to rent your cash for the beta management. And it didn't work for a variety of other reasons.
Well, the problem is it's S&P. That's like the least amount of short lending revenue. You want to be doing something that got a higher revenue.
A little more exotic. Yeah. It was an interesting idea, but it's a pretty common practice that funds do. Many of them do it to obtain leverage. And the key for us is we don't do that. We never lever the fund. We reinvest it in super short treasuries, money market funds that are dollar stable. The idea is we're not trying to take added risk. We're just trying to maximize total return for investors in T-bill. The same thing they would do if they had the same size and they were doing this for themselves.
We did a bunch of episodes in the past on short lending, really around kind of the meme stock phenomenon, because I feel like of the list of topics that investors don't pay that much attention to or even understand, short lending to me was always one that can be material, where the amount of income going to a fund, it could be 5 basis points, it could be 10, it could be 20, it could be 50, it could be 100, depending on what it owns. And so we did a handful of those back then. I was marinating the other day and I was thinking, as the interest in a lot of the long, short, leveraged direct indexing offerings come online, which is a lot more short individual companies, I wonder if that's going to increase the short lending revenue to the long only owners, or if it's just not big enough to be material, TBD. But it with so much of a focus on certain things, investors often will not take into account something like short lending, or the fact that ETFs management fees are tax deductible instead of a separate account. All these little things, taxes, end up having a bigger alpha, a lot easier alpha than fighting the hedge funds for investment alpha. At least seems like it to me.
It's easy, right? Look, we all pay taxes. Ben Franklin made that pretty clear. Death and taxes, there they are. And it seems like we should allow investors to make the decisions they want to make. I've done it myself. I'm going to guess you have as well. A lot of folks listening. I've not made a trade because I didn't want to pay the taxes on something I had to sell. And so there I was holding on to a trade or fund or security that was not even less optimal. Something I didn't want, but I just didn't want to pay the capital gains. It's this like mental block. And over time, we got over that and be like, you know what? I just don't want it. It's better to be in the right security that'll make the right return in the long run than be afraid of paying taxes today. But we get that's a real consequence for folks, because you are going to pay taxes and you may forget and may lose principal, and then you got to sell later in the year and you kind of make the problem worse. But for a long-term investor who wants to hold the position, for folks like us, just how do you just make the right tax decision, make the right call? Let taxes get out of the way. Don't worry about if it's in your IRA, 401k, taxable account, trust account, whatever it is. Just buy the right stuff. It turns out in the long run, that's the right answer. And we think part of what Compoundr will do is allow folks to get there and just keep reinvesting. Warren Buffett said, eighth wonder of the world, right, is compound interest. You're going to really see that in action. And now you can make the right call. Don't not buy fixed income and you've done some, nice LinkedIn work with the good graphs where you look at how much of your return versus how much did you get after you actually paid your taxes. Let's not make decisions around that anymore. Let's buy it because it's the right thing to do for your long-term allocation. And then in 20 years, let's turn around and see how much money we made, as opposed to how much money we didn't make because we were afraid of having to sell to get a 1099 at the end of the year.
Yeah, and it's funny because if you look at like certain categories, I mean, compared to like traditional mutual funds where you could buy the mutual fund and they'll have some on the Morningstar list where they'll do 20, 40, 50% distributions, capital gain distributions. You may have a loss in that fund. So at least getting that initial decision right, the structure, whatever it may be, or at least the concept ahead of time, saves you some headache down the road, or usually quite a bit. But yeah, I agree. The used to always joke with people who would be sitting in these highly appreciated positions and they say, I can't sell it. Can't sell it. Taxman's going to kill me. And the investing joke was always, well, the market's going to solve that for you one way or the other, right? You know, the stock's going to go down. We were having that conversation with a coworker. He's like, oh man, I own some NVIDIA. I'm just waiting for the 12-month long-term to tick off. And I said, man, that's a arbitrary deadline. Good luck. I hope it works out. I don't know.
It's strange how taxes drive us to make some pretty weird decisions. And, particularly we've all worked with, friends, families, investors, clients, just said, don't want to do it because I'm afraid of taxes. Well, you're going to pay some tax anyway, right? Like, would you rather watch it go down? I've heard the argument, well, wealth is made through concentration, so I should just stay concentrated. Like, that's a great rationalization until that thing goes bankrupt and now you've lost it all at the same time. And it's unfortunate when you know the investment call. Look, being the business that we're in, we got to throw darts. Yeah, we're throwing darts and we got to hit the bullseye every time. And it stinks to not be able to hit the bullseye because someone covered it up because they're afraid of the tax load of it, or you hit the bullseye and they take the dart out of the board because of something you hadn't controlled for in the trade. And we think Compoundr kind of solves both in the sense of do the simple thing, try to remove all the noise so you don't have to worry about that dart falling out, and then just make the right call where you're not worried about the sort of consequence of it. You're in it because it's the right investment. And in 20 years, you'll be a lot happier.
So speaking of 20 years, let's look out over the horizon, 2025. You guys have been pretty innovative, cranking these funds out. What else is on Alex's mind? What are you thinking about, excited about, worried about as we look out towards the rest of the year and into 2026?
Well, we've already talked about bonds. So like we probably had to lock the doors or prevent your iPhone from turning off to listen this far. So let's just try our luck. Mutual funds, mutual fund share classes in particular. I know it's like back to the future here, but that share class relief that a lot of us have asked for, that got a lot of press earlier this year and end of last year, it is a real thing. And for folks who aren't following the peculiarities of mutual fund tax and administrative rule, the idea is pretty simple. Allow someone who has a fund to offer a mutual fund and an ETF share class on the same pool of assets. Doesn't sound that exciting. So you think about the ability to take that highly appreciated mutual fund where you're picking up capital gains that are being distributed to you, even if you lost total return on the year, and then now tax-free convert that into an ETF share class, pick up better liquidity, all of the other wonderful things of ETFs. We don't have a lot of mutual funds. We have a lot of ETFs, and we're excited about offering mutual funds. Gives us access to the retirement market, and we like the ability for investors to maybe even trade in kind, do elements of those 351 transactions that folks really like, but to do that on a near perpetual basis. It's a little clunky, it's difficult, hasn't been tested yet, but we're looking forward to figuring out how does that work into the economy of things. And, rather like TBIL and its benchmark mates, a little bit like our bill, like Compoundr, it's just always little frictions in the market that we're excited to keep chipping away at so you can more fluidly invest and stay in products. If I had a guess, though, I'm going to guess you and others are going to continue to do some really cool tax stuff as well. And since I'm a taxable investor, frankly, I'm looking forward to it.
In the discussion of the mutual fund and ETF, I mean, the simplest thing, which I've always said, is they should just equalize them and say, look, both, if you're trading within the fund, just make it so that it's not a taxable event. Like that seems simple to me, but it's the government regulators. So simple is probably, they got to figure out a weirder workaround. But it's always been strange to me that, you're going to give one structure the tax efficiency and the other not. But I probably give that a small chance of happening. I don't know. What do you handicap the idea of the dual share class happening 25, 26?
26, close to 100%. I'm a risk manager. It's
Oh, wow. You got some DC insight there. Is that just hopeful thinking?
We've applied for it. We've had, a fair bit of conversations with regulators, with co-applicants for this process. We think this is coming along. I don't think it's going to be as broad as some folks are hoping for. Like they're hoping this is going to be the thing where you can take your 25 years of low basis stock in a mutual fund and the next day just wash away the gains. And that may not come to pass. I think a lot of folks are also assuming that everyone is just going to jump in and every mutual fund that you like is now going to have a lower cost ETF share class. I don't think that happens. I think that'd be economically difficult for managers, and also running an ETF is just different than running a mutual fund, right? Mutual funds are individual games. Everyone's in the primary market together. The manager does all the trading. ETFs are a team sport, right? We need to coordinate a lot of things. And when it works well, it works great. And just the mentality of the two are different. So I think there's a lot of pressure put on what it will be. But realistically, for those who do it well and who've taken the time to study it, I think you're going to find there's some really cool solutions. I think the industry wants it. I think the regulators have asked a lot of questions, a lot of great questions. The tax man will have to opine on it. And let's not forget the regulatory authorities for securities are different than the tax authorities, right? Two sister agencies, but separated by a few miles here in DC. So I think it'll be interesting to see that. But I think that's coming down the pipe. I think there's a big market for that, certainly of legacy mutual funds who are desperate to not convert and more afraid of cloning their funds. And for folks like us, we'd love to offer this to the retirement market and to explore the mutual fund, structure that it hasn't much changed at all and kind of gets maligned by all of the ETFs. We think it might have a trick or two up its sleeve that's still really useful.
One of the funny things I always think about when we're talking about taxes is say, look, people, you should pay all the taxes you owe. We don't make the rules. I could philosophically debate with you about what things should be, how the world should look. But the reality is we have the menu in front of us and you should pay every cent of every dollar you owe, but you should minimize that amount. I feel like it's a duty to your family and your friends. Like if you want to pay more, it's funny because you always see people like, I love him, Warren Buffett and others, they're like, my tax rate's too low. And I always kind of scratch my head and say, well, like you can make your tax rate whatever you want. Like if you want to pay 75%, you can. Like no one is stopping you. And the IRS has a thing where you can donate to reduce the national debt. And so one would think that like 10, 50, 100 billion, 500 billion, like all those people that said my tax rate should be higher have donated. And the sum total, I think, is like $30 million. It's like so little. Everyone's like, they're out there, demonstrating like kind of stolen valor. Like, oh, I believe my taxes should be higher. I should pay much more. And be like, well, do you?
Just do it.
No.
No, I'm not stopping
Go ahead.
It's the least used line on that tax form, I assure you. We're the same thing. We think you should pay every dollar tax. I do, right? It's your accountant's job. It's your financial advisor's job. I agree with you to help you pay the amount that makes the right amount that you owe, but to try to minimize it because it is an investing friction for you. And there's also a difference between not paying your taxes and deferring when you're going to pay your taxes, right? ETFs are great because they're deferral mechanisms. They're not some sort of cheat code where you just never pay your taxes, right? The only cheat code to that is the step up in basis for your heirs. And to get that one, you're dead. So like if that's the last trick you want to play on the government, good on you, mate. But it's a pretty long game with a pretty morbid outcome to not pay 20 or 30%.
We did a post because, some people ask us as we're talking about 351 or the things you guys are doing in Compoundr and elsewhere. They're like, Matt, are you a little worried, the regulators? And I go, first of all, let's talk about like in the tax code, let's make the list of the 20 things that are like truly egregious and where people like, it's like, there's things that we had a post on Twitter. I was like, what's the most ridiculous tax break? And there's some really wonderful ones. We'll put it in the show note links, listeners. You can see what Cliff Asness said, and you can see what Wes Gray said, and all of our other podcasts, Dave Nottig, what all the podcast alums have said in here, none of which are what we're talking about today, oddly enough. But you look at a lot of the ideas, and you're like, wow, that's actually odd when you think about it. Like that one seems really, but it's legislation, right? That's people, vested interests writing it in over the last 200 years.
Some pork barrel legislation where you look at the Denver airport, you're like, all right, clearly someone owned land out here, because why in tarnation would we build an airport so far away from the city on the wrong side of where everyone's trying to go? And then you hear the story about so-and-so owned this thing and there was a tax break that was written in. Like you should read the tax breaks of these companies that move to cities and certain plots of land. And they're like, if you're in this geographical GPS zone for more than 8 hours on a Tuesday, you get the tax break. And it's like, come on. I mean, that's politics in action. And we've had the same questions like, hey, is this going to attract attention? And it may, and maybe it should in that sense. But the ETF and its taxable capabilities, right, being one of many features they offer, are balanced by those others. Like the ETF is the most powerful force to hit Main Street investing since maybe the bank account. Like it's really hard to mess with that. The $12 trillion sitting in it, that's on its way to 20 trillion, by the end of the decade, if not sooner. It's going to be hard to change the rules of something that's become so ubiquitous, so loved, and so used by all investor types. But, largely speaking, Main Street as well. I mean, look, we can't get rid of carried interest, and that impacts, 0.1 of 0.1% of the population.
That sucker's a cockroach. No one can kill that. No matter how hard they try, it comes up every 4 years. There's carried interest is going to outlast all of us. No question.
Exactly. You mentioned something that's probably worth mentioning of Dave Nottig. Dave just took back some of the reins over at ETF.com. So I know Dave's a great guy and does some great work. I hope he's still going to write a Substack because I love reading it. But I'm really excited for all of us because I think we're going to see a lot of great content come out of there. So, kudos to Dave for taking it on.
I was CCing Dave on Twitter because I said, is anybody going to Future Proof that has a big, beautiful, bald head that I can rent some space on? Put a nice little ETF logo on the side. We'll pay good money. Listeners, we got any beautiful baldies that want to make a few bucks for Future Proof? I think compliance will approve that. I don't know. And you're okay with a ticker on your head for a few days? I assume it'll wash off after a week. I don't know. Could be permanent.
They said it was a temporary tattoo, but we're not making any warranties about that. So we'll see.
What's been your most memorable investment? Good, bad, in between, hedge fund, current job, chemical engineer, anything?
I think the thing that I bought the most interesting, I bought a share of Citi for 99 cents during the GFC, figuring, what the hell? And I paid the extra $150 to have the share certificate sent to me, and I still have it. And it occurred to me, I spent $100 on a stock that maybe I paid back for my share certificate for, just out of sort of pure simplicity and vanity of the thing. That's probably my favorite because it was in that time when everything was so cheap, right? They're just like giving these things away. It's like, how are people not buying more of these? The stock market isn't going to go away tomorrow, and it may not bounce back to 10x, but it ultimately would. So, what did I know? That's one of my favorite. I mean, I've had a lot of little things that I've invested in, but that one kind of just, given all the things we do in markets, probably hits home the most when you watch a giant like that can get so low, but then, can come back so far.
I love reading the old investing books or books about history. We're writing a book right now, and so I've been buying any investing book that focuses on investing history. We did a fun post on Twitter, said, look, here's a stack of books that I'm reading. What am I missing? And we got like 20 other books I'd never heard of. One of them was a really fun book called Art of the Market. And it basically profiles all these like stock certificates and art from over the years. This is by Bob Tamerkin and Les Krantz. Came out in 99. It's an absolutely beautiful coffee table book. Get it for $20. Anyway, it had in there, I also mentioned this, but we got to be careful putting in the show notes, a little PG-13. Playboy used to have, bar none, the most beautiful stock certificates. But if you're watching this on YouTube, you can see over here, and I can't remember who sent it to me, but an investor sent us a Greek bond from 1898. So there's some fun stories from William Getzman, I think I got the last name right, who talks about the Netherlands and the Dutch had a perpetual bond that's supposed to pay forever on some like water canal or something. And they bought it when he was at Yale and then took it over to the Netherlands and presented it and say, you guys owe us like, $50 or whatever it was, which is pretty cool.
I've heard that story. He has a great book that is in, as you mentioned, Playboy, sort of like, financial security instrument porn. Same thing, just 200 and 500 years plus of coins and minting. And he's got a picture of that actual bond and that story in the book. It's, You and I have the same coffee tables. Thank God our wives throw those away when like real people come over because they want them to come back. But some really cool stuff. I did some work with American Banknote. Companies to print money for the United States, and they made that their office was just filled with these beautiful stock and bond certificates. Like Disney used to have all the characters hand drawn on there. Barnum and Bailey had these fantastic one with clowns. Like it's a lost art form.
Yeah. Speaking of Getzman, we need to get him on the podcast, but I was just flipping through this week. He bought some of his books and I'd never heard of some of them. One, which also got turned into a documentary, was called The West of the Imagination. And it's about like American art and American history, particularly in the West. But I think the book you're talking about might be Money Changes Everything, How Finance Made Civilization Possible. And that is it's a thick book. And there's one more. Sorry, listeners, you're getting a bunch of to-dos. The Origins of Value, the Financial Innovations Created Modern Capital Markets. And that's kind of the picture book you might be talking about, actually. All of them worth reading.
I wasn't going to scare people on YouTube. I go over and get it. It's sitting in my bookshelf over there because it is really a great, beautiful book. And I think actually when I got it, one of my colleagues, Scott Welch, knows Will pretty well. I sent it off to him. He signed it and sent it back to me. So I got it sitting there and I'm afraid to open it, but a beautiful book. Now everyone's like, all right, now we're listening to these guys talk about bonds and ETFs and mutual funds. They're giving us reading assignments. Like it's back to school already. So here we go, but it's good stuff.
If people want to follow y'all's funds, what you're up to, your research, what's the best place to go?
fminvest.com. We post everything there. New website just came up and all the new features are coming online. So you'll see a lot of action from us at fminvest.com.
Alex, thanks so much for joining us today.
Thanks for having me.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.